And good morning, everybody. Welcome to today's program. This is Andrew Wilkinson. I'm the Director of Trading Education at Interactive Brokers in Greenwich, Connecticut. And with me on the program is Senior Economist Jose Torres. Welcome, Jose. How are you?
Hi, Andrew. Happy that the government is reopened. So I have a little extra energy this morning. Doing great. How are you?
I'm alive. I'm alive. It's good. It's all good. So let's talk about that. That's our opening point today. So the Senate put a package together, voted yes over the weekend, upsetting many Democrats. But that the measure got through the House yesterday evening, and then I believe it's been signed by the president. So what now? What are the mechanics behind this now, Jose? When are we likely to see activity in Washington again?
Yeah, so federal workers are expected back to work today, Thursday morning, on November the 13th. As far as the elephant in the room has been airplane and travel disruptions. We have Thanksgiving coming up in a few days. We have Christmas next month. That's going to take a little longer. That's expected to take around 5 to 7 days so that flights are back to normal. But it's been a big relief for the airlines because, of course, the Thanksgiving time period is very busy. A lot of flights being scheduled, and inconvenience or cancellations or delays could really weigh on consumer spending as well as consumers planning and revenues for the aircrafts as well as for the hotels. In fact, the government shutdown that just ended was the longest in history. And that's expected really. We're going to check our forecast trader later to see how our participants expect fourth quarter growth to come in. But, prior to the shutdown, conditions were quite buoyant. But now I'm personally expecting growth to be somewhere in the 1.5% range or so. Prior to the shutdown, I was projecting somewhere around 3%.
So you think there's definitely been a notable impact on activity?
Oh, absolutely. When you consider the multiplier effects of federal workers not being paid, vendors and contractors not being paid, as well as, like I was saying earlier, the inconveniences of all and the multiplier effects of all the cancellations and the delays, that's really weighed on economic growth. Overall, a lot of folks just say, hey, you know what? I'll just do it on Zoom. I won't travel. I won't stay at a hotel. And then, of course, the federal workforce is pretty large at around 2 million. When you add contractors and vendors, the multiplier effects are quite significant. So definitely has been a drag on economic growth overall. Just the federal workers not consuming. Federal workers do earn more than private sector workers on average. Just the fact that they're not consuming because they're not being paid, that alone for an economy that depends so much on household outlays, that alone, the multiplier effects of that are particularly significant.
So talk to us a little bit about the impact on the consumer. I think the one I'm driving at here is the University of Michigan Consumer Sentiment Report.
Yeah, so I'm going to pull up some charts, which is a new effort, Andrew, here, to give a more visual experience to our audience. By the way, we thank you for all of you for joining us via YouTube, LinkedIn, Twitter X, etc. Consumer sentiment fell to its lowest level in 41 months since June 2022. Really, it was blamed on the shutdown, as, alongside elevated costs as well as high interest rates and general uncertainty. Let me share my screen, folks. Bear with me. And thank you, Andrea Brown. She's in the background helping us manage here.
There we go.
Get this to zoom in a little bit. But as you can see, folks, consumer sentiment dropped for the third consecutive month, near its Well, sorry, folks, this hasn't been updated. The November number is down to 50.3. So it was been the lowest number since June 2022. Apologies, this chart does not reflect that. But overall, folks have been concerned, like I said, about elevated prices, high financing costs, as well as a lack of job availability. We got the numbers from ADP last Tuesday, and they presented a picture of really contracting payrolls during the month of October. We heard from the White House also that we may not get October economic data on CPI and employment. I was expecting that we were going to get those numbers next week. So we'll see. We may have to wait a little longer to get more clarity on the economic outlook. Of course, the Fed is focusing a lot on job market stability at this point, even though inflation is way above its target. And the reason is because if the unemployment rate starts to climb and payrolls gains remain subdued, then the Fed's really going to have to come in and start to cut even more, despite inflation being way above its target.
And you could put your question, you can submit any questions on the economy, on economics to Jose by typing them into the chat panel. And you can find us at LinkedIn and at on the Interactive Brokers X channel. So, Jose, what about private sector job reports such as Challenger, Gray, and Christmas, and then any other anecdotal signs of layoffs? Oh, here we are. Let's just nip back to the consumer sentiment. So that's
back to the consumer sentiment. Yes. So sorry about that, folks. Here's the updated chart. You see November here, the lowest since June, dropping for the fourth consecutive month. We're probably going to see a bounce, but in December following the government's reopening. But these numbers are not particularly friendly. A lot of talk about a K-shaped recovery in the economy after the first quarter's decline, and really middle income and lower income households are having a much tougher time compared to higher income households that have really been driving more of the consumption. They've been benefiting from house asset price appreciation, as well as gains in fixed income, as well as stocks, which have been terrific. Also, crypto is in a malaise lately, but above 100,000, still good gains over the last 5 to 10 years or so. Gold has been rallying. So really those asset owners and traders overall have really benefited from a robust capital market landscape, and they've been helping to really drive economic growth north, despite the fact that middle income and lower income cohorts have been struggling.
So what I'm going to be intrigued by is when consumer sentiment is next reported, is next surveyed beyond the reopening, how much it will move the needle. Will consumers turn and say, yeah, I feel a lot better about things now, simply because the government has reopened? Is it back to business as usual, or are they just going to look around and say, you know what, we need the government to be open and doing things, but what they are doing is not actually improving my situation? What are your thoughts on that?
Yeah, I think there's, generally speaking, we've been seeing in our forecast trader last week's elections, November 4th, we saw the Democrats really win by large, sizable quantities in the New York City mayoral election, as well as the elections in Virginia and New Jersey, Proposition 50 as well. So our forecast trader, and I'm going to navigate there too as we speak, our forecast traders essentially at this point expecting the Democrats to do really well in the midterm elections in 2026. I think the issue with the consumer sentiment is that President Trump and the GOP, their goals are more medium term to longer term, but households have been under pressure from the end of the Biden administration, really. and really seeked short-term benefits and short-term results from President Trump. That he's and unfortunately at this point, the GOP has really failed to deliver a lot of gains for the middle income and the lower income households. Yes, wage gains are well above inflation, and that's positive, but that hasn't been enough to really bolster living conditions overall. Manufacturing jobs, they've been down all year, despite the fact that investments have been through the roof. So AI adoption is also working its way into the constituency and worrying folks about job prospects. So we're going to talk a little bit about, we'll go to manufacturing employees, and then we'll go to the midterm elections in our forecast trader.
And of course, the manufacturing sector, employment-wise, is where the whole "Make America Great" argument should really be seen. And I think the government keeps trumping the fact that companies are investing in the United States and onshoring, I guess is the right word for it. But how are we seeing that in the manufacturing employment numbers, Jose?
Yeah, no, the employment numbers, we started January at 12.75 million, and now we're down to 12.72 million as of August. So, really a loss of manufacturing employment, not a significant, falling off a cliff loss, but nonetheless, not the buoyancy a lot of the Rust Belt states expected when, the president was out there campaigning, talking about much better job prospects and the manufacturing renaissance. Again, that doesn't mean that those goals aren't going to come into fruition or that next year manufacturing employment isn't going to go through the roof. It just means that the progress has been slow, folks. And the constituency wants, during President Trump's first term, there was a feeling that results were a lot faster. But now these goals, specifically with the trade policy going against most nations, really, average tariff rate of 15%. We know during Trump's first term, the focus was mainly on China. Now the focus is much broader. And it's really going to take time for those gains to be made in the labor market. But then, like I said, another worry is that a lot of the onshoring is going to be driven by AI and not necessarily going to support households directly via a lot of high-income jobs, which is what's needed in a lot of those Rust Belt areas of the U.S. that could use an economic recovery.
I'm just looking at some of the questions coming in from the audience here. So let me just come back to one of the points you were making there on the manufacturing. Yeah, I get it. With a lag, manufacturing work may come back. So are we seeing anything in the construction sector? So first of all, you might need to build a plant, right? Is there anything in the construction employment sector that would indicate that policies are working yet, or that onshoring is improving?
I think that when we construction, has made gains year to date in employment. We started off at 8.286 million, and now we're up to 8.295 million. We were up to 8.3 million. So construction has been a little better than manufacturing overall. The investments have been through the roof, and that's really where the onshoring story has strength. But the employment and the ordering has been weak. And that's why the ISM survey has been in contraction for 8 consecutive months, because the reality is that the financing costs are too elevated. And then prices also are very high. So that mix makes it where these capital intensive purchases are more difficult to close. Similar in real estate, you're having the high price, elevated interest rates also weighing on orders, weighing on closings, weighing on housing starts. Home builders don't want to go out there in an environment that has ample inventory and start to add significant supply, because then their margins could come under pressure and they could even take some losses on some properties. That's the story there, folks. Here's the U.S. House of Representatives control. Will the Democrats win the House, a majority in the House? We were, the last month, as you can see, before Election Day, the odds were up to around 58%, but now we're up to 69% is the highest bid right now, but the last trade went through at 72 cents. So there's really a high odds, high degree of likelihood that the Democrats are going to win a majority in the U.S. House.
Got it. So let's talk a little bit about inflation. So we seem to be stuck around the 3% level. There's still consternation over who, not so much who's paying the tariffs, but whether inflation from that will come down meaningfully. But I'd have thought that, I'm further in the camp that there will be another interest rate cut in December, but I'm not really sure that is the narrative on the street. To be honest, people seem to be saying that maybe not, but maybe more so in January after more information's been released. But I think we pretty much know what's happening with inflation. What we don't know is how bad the employment situation is. The other side of the Fed's dual mandate. What are your thoughts on an interest rate cut in I think it was December the 10th?
Yeah, I think we're going to get that December cut. Right now, the odds are up to 66% in our forecast trader. When we
But
look
they were
at
a lot higher, weren't they, following the last October cut?
Yes.
Yeah.
Yes, they were up to October 29th. You were up to 87%. You got up to 80% on October 27th. And now you're down to 62% was the last trade, but the highest bid right now is 66%. So
this is great for anybody who wants to take a side on this, because it's certainly more level. I mean, you could have previously you were paying 82 cents for the certainty of a December rate cut with that event contract, and now you're back to 67 cents. You say?
Yes, 67 cents. So, but you are going to get some data before that. So if you get a blockbuster November payroll, this could all of a sudden start to decline. We've had dissenters, and we're expecting more dissenters in the December meeting. 95%, folks, that we're going to have at least one dissenter. Look at the number of dissenting members.
Now, Jose, the number of dissenting members, what does the contract say? Is that the actual voting members? So that it's what? How many members vote at the meeting?
12
voting members, because there are 19 on the committee that submit their predictions in the quarterly summary of economic projections, right? So we're talking about those 12 people. That's interesting.
Yeah, we're expecting dissents. We know that Governor Myron has been in favor of sharper cuts to the downside, and then we've also had some dissents favoring pauses or keeping rates steady, just because inflation is strong right now. As far as what's been driving price pressures, it's really been services and strong consumer demand driving pricing power for purchasers, for businesses rather, and then also you have a labor situation where you don't have the labor supply. So going back to the labor market analysis, you do not have labor supply because immigration restriction has essentially blocked a lot of those folks that we've counted on to bolster our supply of workers. Those folks, they're not here. So because of that, payrolls are going to be hampered to the downside. And then also from a labor demand perspective, you have AI adoption, starting to weigh on entry-level hiring. And then you also have the rate-sensitive areas of the economy, namely, like we were talking about earlier, real estate, construction, manufacturing, and then small business. That folks, they just don't feel comfortable adding employees in this environment. Small business loans with the Fed funds rate where it's at are going for 8%, 10%, 12%. It's hard to really expand payrolls and make returns on that kind of heavy financing costs. And that's why really the Russell 2000, it's a good gauge of smaller cap companies, not necessarily indicative of the entire small business landscape fully, but has a strong correlation with it. And you've seen the Russell 2000 really got to an all-time high, but it's really been struggling to make further progress. Still roughly flat from its 2021 level. If I'm just going to pull up that chart here.
And in the meantime, I'm just want to talk a little bit about the crowd that's joining us today from Investmental, one of our partners here at Interactive Brokers. Investmental is an app that you can download and learn about economics. And we've got a few questions from some of their members today, Jose, which I wanted to address now because that's kind of what you're talking about. Why sometimes do stock markets go higher and improve on seemingly worse economic data?
Yeah, so sometimes worse economic data drives increased expectations of looser financial conditions. And because of that, that alleviates valuation pressures and drive stocks higher. But that balance is key, because if the economy is falling off a cliff, then corporate earnings expectations have to come in. So then that's the key, right? Is economic data worsening enough so that it warrants Federal Reserve loosening without going into recession, right? And there is a risk of that too when we look at our forecast trader. Recession by fourth quarter 2026. So next year's fourth quarter is up in the 40s area. So, there's a risk that the consumer is essentially going to really halt spending because of a deteriorating labor market situation. We got numbers this Tuesday, just passed 2 days ago on the 11th from ADP. ADP on weeks, here's the confusing thing, folks. It's a weekly number, but on weeks when ADP is releasing its monthly employment data, those weeks will not feature the weekly employment data from ADP. So we got the number on November 11th. It was negative 11,000. So that's the 4-week moving average going through October 25th, down 11,000. So October overall has been bad. Going back to your earlier question, we've been navigating through charts and the forecast trader, so we're a little scrambled. Hopefully it's entertaining for you folks. Going back to your earlier question about the Challenger October job cuts, the most since 2003 in any October. So 22-year high in job cuts. Revelio Labs, also an alternative private sector research provider, reported 9,000 jobs lost in October. So, October with the government shutdown and just general labor market deceleration looks like it's been a bad month for hiring. And hopefully early next year, I'm counting on somewhat of reacceleration because of the reopening, first and foremost, but then also because the legislation passed this year in 2025 supporting lighter taxation and milder regulations. That's going to generate a stronger tailwind for markets and the economy in 2026.
Another question from the Investmental team, Jose, is about the value of the dollar. What are some of the factors that drive the value of the dollar relative to other currencies? And I'm going to just throw in as well, why does it matter? Why does the value of the dollar matter here?
Sure. So let's let's go to the first question. So, what are the factors that move the dollar? So, one of the things are central bank differentials, and that's essentially when currencies, central banks representing currencies, are paying high risk-free rates, then currencies navigate to the dollar in this case because the Fed's rates are higher than, for example, the ECB's rates or the BOJ's rates, etc. So that's one thing. Two, of course, is not just Fed rates, but also duration. So if the 10-year yield, the 20-year, the 30-year, if those rates are a lot higher than other nations, then folks are going to want to have more dollar exposure because they're getting paid higher risk-free rates as well. Then you have, of course, inflation, which affects the rate complex. You know, when you have higher inflation in developed countries, the story typically goes that the higher inflation produces a stronger currency because the central banks are going to raise rates to tackle the inflation. But in emerging countries, the higher inflation could actually be very detrimental to the currency because though a lot of those countries don't have the same borrowing capacity that the developed nations have. And so they're essentially forced to maintain high inflation rates. And then that, of course, destroys the value of the currency over time. So that's the relationship really between developed nations and emerging nations. That developed nations, there's a lot more of an allowance from the investor community for high inflation based on the expectation that central banks are going to come in and bring it down. Whereas with emerging nations, the fear is, oh boy, the inflation is going to go and it's never going to come in. So be careful with the currency.
And I suppose, why does it matter? I mean, if you look at the bottom line with why does it matter is a weaker dollar makes American goods look more appealing, right?
Yes, absolutely. If you have a weaker dollar, then folks in other countries can afford your imports incrementally more. So that's the benefits of a weaker dollar. But then if you have a stronger dollar, then what we're importing into the US or another nation's exports become cheaper because we can buy more on an incremental basis.
So it's kind of a double-edged sword, isn't it? What do you really want? The US Treasury has for many, many years, and I'm going back to the 1980s, has always argued that we want a strong dollar. It benefits the United States. It represents the how this country is, how it looks, and how it feels. But one of the whole tariff policy is kind of underneath it. Some of the roots here are currency manipulation. So there's been a strong argument put forward that other countries are manipulating their exchange rate, making their currencies cheaper and weaker against the dollar, and therefore the US has been harmed. So no one's really going to say it, but yes, the dollar's been weakening this year, and that is beneficial. But nobody really wants to kind of go against that prevailing Treasury mantra, which is we appreciate a strong dollar, right?
Yeah, no, and it depends really. These are the kinds of things that, it really depends where on the economic debate you are. I'm more of a hawk naturally, so I'm in favor of a stronger dollar. But then you have folks that, they prefer more weaker currencies, like, folks that are really focused on bringing manufacturing back and creating a more level playing field on trade. They'd probably be more in favor of a weaker dollar, more dollar. That's when they go to countries dollars. That I'm frozen. 1 2 1 2.
Nope, you're good. You're back.
Can you hear me, Andrew?
You thought
good? Okay, I'm back.
Yes.
Okay, I'm. Well, it has been the weather has been cooling, folks. It is autumn. Here is a a chart of the dollar on a year-to-date basis. We had the big Sell America trade to start the year that brought the DXY down from around 110 or so down to the lowest, which was around 96.39. But we've had a recovery since the lows in July and in September. And this 100 level is very important for the dollar index, folks, is the DXY. Because it's, we know that in trading, and Andrew, you can tell us more, of course, but round numbers they matter a lot. And you saw the dollar really rally off of rates being stronger and economic growth prospects firming up here in the US and really get past that 100. But that could have been maybe a false breakout because we have these series here of red candles now dropping. So this 100 level is quite interesting for the dollar.
Yeah, I think some of that is you mentioned earlier on yield differentials. So when it sounded like the Fed was not going to cut much further, then there's no reason not to buy the dollar. And I think that the longer the government is shut down, the less transparent the economic data is, and therefore, again, it's safer to buy the dollar and hold it until you get some clarity that will allow the Fed to make a decision on rates. So I think with the reopening of the government, maybe that sell the dollar accompanied, alongside negative economic news is a good reason to sell the dollar in this situation. So on the forecast trader, is there an event contract for where the value of the dollar is going to be at year end, Jose?
Yep, we're going to navigate to our dollar contracts now. Maybe we go to the next question, Andrew, while I navigate.
Yeah, certainly. And the next question from the Invest Mentor crowd is about the impact of recession on the man on the street, the regular investor, and what does it mean for his or her portfolio?
Yeah, so if the investor on the street is invested in, here are our foreign exchange contracts.
Can you enlarge those, Jose?
Let me see.
You make the screen full screen?
Oh, yep, we're going to make it full screen rather.
And don't forget to the audience, please address your questions at our channel on X and LinkedIn. We'll try and get to those too. So we do this by each exchange rate, so you can actually take a view on each one. And my eyesight isn't that good, but the third column there, is that fixed?
The third column is the Aussie dollar to the US dollar.
Yeah. Yeah, so
zoom that in a little more.
Days to close. So these are quite routine. They're quite regular.
Yeah, if we look at the
dollar yen,
the dollar yen, we see that there's some frequent expirations.
Okay, so almost daily, but certainly a couple of times a week.
Yes.
Yeah, so you can play those contracts too. Okay. Jose, have you got some information for how to download the Invest Mentor app? And what about Mr. Sosnick today? Is he back with us?
Mr. Sosnick is back with us. Let's go to Mr. Sosnick.
Hi, I'm Steve Sosnick, Chief Strategist at Interactive Brokers. Where do you think inflation is going? Do you see a recession ahead or more growth on the horizon? What's your prediction for the Fed funds rate? Right now, 73% of traders expect it below 4% in December. What's your forecast? Interactive Brokers forecast contracts let you turn insights into action. Buy yes or no contract on Forecast Trader and earn $1 for each correct prediction. We invite you to explore the data, spot the trends, and make your call. Start forecasting today at ibkr.com/forecast. The best informed investors choose.
And we're back. Thank you, Steve.
I know that video is a little. We've had that video around for several months now, and it's interesting to see some of the prices that are on screen there. I think Steve said 73% of traders expect the Fed funds rate to be lower than 4%. It already is, right? And it's only November.
Yes. Yeah, the Fed's funds rate is expected to, go lower despite inflation here's the latest CPIs of September. We're up to 3%. Strong growth has supported inflationary pressures. Going here to the U.S. economy chart, we grew quite strongly in Q2, almost 4%, recovering from the decline in the first quarter. Third quarter is probably going to be right around 3 to 4% or so, but then fourth quarter is going to be roughly 1.5. Here's a chart of ADP hiring. We've seen that from January to the recent month of October. That really the 3-month moving average, folks, look at it. It's right on the black line. That's the zero mark. So this is a very dangerous time here in terms of labor conditions. As far as recessions and how they, going back to the question, recessions and how they impact the investor on the street. If the investor on the street is in equities, then a recession is going to be negative for stocks because corporate earnings come under pressure when consumers are not spending. Revenues are down. Costs, of course, can't come down as fast as revenues if consumer spending just halts right away, and then earnings come in, and that's the most important factor that drives share prices higher. Of course, to gauge what consumer spending is going to do, watching the labor market is pivotal. We've already lost jobs in several months. If you look here, you see that June was a loss, August was a loss, September was a loss, and the 3-month moving average, like I said, is at zero. Going through some other charts here, the greenbacks index has strengthened. Similar chart that we saw earlier, just without the candles. That 100 area again, really pivotal, broke above. That now it is below. Consumer sentiment, we saw small business optimism dropped again. We saw that last week. Weaker growth expectations, supply chain issues, high input costs really weighing there. But home builder sentiment is improving, albeit it's still in the basement, folks. You look at these June, August, October numbers are the lowest since December 2022, also around November 2023. The 50 is the break even between the threshold between positive and negative. So, lower mortgage rates are driving optimism that, things could get better. Of course, President Trump he's been attempting to get the Fed to lower rates. That doesn't directly affect mortgage rates, but it does help. With Chair Powell's term ending next year, there's a chance that the Fed will be a lot more dovish than it is right now. And then some contracts looking forward. Will the U.S. economy enter recession by the end of Q2? 22% low, goes up to 43% though when you go out to Q4 of 2026. Will the Supreme Court uphold tariffs? This is a big one here, folks. This was around the 50-50 mark, but now it's down to 31% last week. Even though the court is represented by a majority GOP appointed justices, those conservative justices during the hearing, they really questioned the president's authority to impose broad tariffs, specifically on countries that we have strong relations with historically, like Spain and France. So because of that, we saw the odds there really drop from around the 50-50 mark down to 28%, 30% or so. And then, of course, the Democrats, after Proposition 50 passed last week in California, heavily expected to win a majority in the House, although the GOP is expected to maintain its slim majority in the Senate by a pretty wide margin, just because the Senate elections are every 6 years. And it just so happens that the seats up for 2026 happen to favor the GOP. So there's really a narrow path for the Democrats to acquire a majority there.
Jose, is there an approval rating for the president in the forecast, in the event contracts?
I don't believe there is, but of course, I'm going to look for it real quick while we go to the next question, if we have one.
But we're all out of questions, Jose.
Okay, well, I think we're all, I think we're good for now. We're going above, we're almost at the 40-minute mark. But Andrew, if you have anything on the top of your head, maybe we look at futures a little bit and see what futures are doing. Futures are down.
Futures are down for the day.
Yeah, futures are down for the day. This essentially means that the government shutdown was essentially priced in. You can see here the ES on the S&P 500 E-mini down 33 bips. Russell set to open down 62 bips. Q's down 42 bips. Dow Jones made a record yesterday, but looking like a down day for equity so far. Volatility protection instruments here catching a bid, up 3%. Let's see what else we have going on.
I haven't really had time to look at the news this morning, but it seems like a classic case of buy the rumor, sell the fact when it comes to the government shutdown.
Yeah, especially with odds going in that were so high. We had our odds up at 90%, which yesterday I communicated I thought was undervalued. I thought those odds should have been 96%. But when we hear yields are up, 10 years up to 411, 2-year up to 360. Dollar index here again struggling to down despite higher yields, which that typically they're correlated yields in the dollar. We look at what's happening from a commodity perspective. Gold is making a recovery, folks. Hit its all-time high here around 4,400, a little below. Fell all the way down to 38.85 or so, and now it's back to 42.30. So the dip buyers look at these aggressive purchases here of a safe haven asset. So the commodity complex really all higher today, minus natural gas. Bitcoin hanging in above that 100,000 level. Let's pull up a monthly here and see the 100. So folks, this is interesting, right? Because the Bitcoin and the DXY, the dollar index, really holding on for 100. The Bitcoin holding on above 100. Of course, the DXY falling below.
It's funny how when there was a recent bout of risk off, it seemed to be kind of spearheaded by Bitcoin, and it somewhat concerns me that this is a kind of a relatively new asset class. It felt a little bit like the tail wagging the dog. I don't know if you have any thoughts on that, Jose.
Oh, absolutely. I think that it's a great technology, the blockchain technology, but we've seen this in previous cycles that when liquidity needs start to increase, so car delinquencies are up near record highs. Consumer sentiment, like we spoke about, down to a 41-month low. When people need money in the middle income, lower income cohorts, and they own Bitcoin, the selling pressure starts to ensue because naturally it does still have that speculative aspect tied to it. Although I know that a lot of the Bitcoin fanatics, and I'm more of a neutral person here, but a lot of the Bitcoin fanatics really try to dismiss the speculative nature of the cryptocurrency. But I think that, the fact that Bitcoin is in a bear market right now, so the all-time high is 126,272, and right now we're at 102,278. So that's more than a 20% drawdown from the peak. The fact that we're in a bear market in Bitcoin, but the Nasdaq and the S&P are still near their all-time highs. The Dow made a record yesterday, November 12th. Tells me that it's still a speculative still has a speculative aspect to it. And when folks need money to pay their bills, they start selling it.
Mm-hmm. All right, very good. Some great insight there today, Jose. Thank you very much for joining us.
Thank you so much, Andrew. Thank you to our Invest Mentor folks. So those folks that are just beginning their investing journey, they can go to Invest Mentor, where we have a lot of free educational lessons, a ton of resources, and of course, you can submit your questions with our Invest Mentor team, and they will happily transfer it over to us, and we will try our best to answer the questions here. I want to give a thank you to our tech person in the background, Andrea Brown. Thank you very much for always being here early in the morning. I also want to know let the folks know that tomorrow, November 14th, we'll be doing a repeat of today, essentially, assuming that things don't change too much in the next 23 hours and 45 minutes. Tomorrow will be at 8:15 with Judith Casasampere, but that'll be in Espanol. So if you're bilingual, you listen to this one, then you want to test me on my Spanish, then come tomorrow. And of course, si no habla inglés, si nada más hablas español, ven mañana para la presentación. So I'm looking forward to seeing our Latin American crowd tomorrow, as well as the folks that are bilingual that want to listen to it in 2 different languages. Very happy for all of your support. Don't forget, go to our Forecast Trader, check it out. We've been growing our customer base. Of course, we've been very successful interactive brokers over the years. And Forecast Trader is a new vertical that, we're not necessarily satisfied with our growth. We want to continue growing in new verticals. So if you're used to using and engaging with more of our traditional brokerage tools that, of course, the Director of Trading Education, Andrew Wilkinson, has a ton of courses on all that stuff. But if that's really what you're used to, we're also looking for you. We invite you to come over to our Forecast Trader, come check the prediction markets out, check out our IBKR campus, our Invest Mentor. And of course, if you need some guidance, feel free to reach out to all of us. So that was a pretty long conclusion, so I'll end it there. Thank you all for joining us. And Andrew, thanks so much for hosting.
Thanks, Jose, and thanks to the audience. Bye for now, everybody.
Bye.